Now, before I actually delve into each one of these, I want you to understand that virtually every single concept I will show you today is applicable on any time frame of your choice. The time frame just dictates how small or large of a trade, of a time frame we want to play. The method, the approach, the patterns never change. The windows change. So if you're a swing trader, you'll want to apply these tactics to a daily chart. If you are a core trader, you'll want to apply these tactics to a weekly chart. You follow what I'm saying? If you want to be a smaller term trader, you'll apply these tactics to a smaller time frame. The three main windows that our day-by-day traders focus on are the 15-minute chart, which they use primarily for support and resistance analysis, the 5-minute chart, and the 2-minute chart. The 5-minute chart by far is the granddaddy of all day-to-day income producers in the market. Our traders focus far more on the 5-minute chart than any other time frame, and they place their trades or make their decisions off of the 5-minute chart more predominantly than any other time frame. The 2-minute chart is also a time frame on which they make buy and sell decisions, but not quite as frequently as the 5-minute chart. Now, the 15-minute chart is also used for decisions at times, but is largely used for referencing the past support areas, past areas of resistance. Let's take a look at the 15-minute chart. On this chart, every bar represents 15 minutes of trading. Okay? Some are green and some are red. All right? Obviously, when there's a series of red bars, the sellers are in control. When we have a series of green bars, the bulls or the buyers are in control. I want you to note very carefully that I have two major moving averages on this chart. These are the two main moving averages we look at on virtually every single chart we ever view. It is the simple 20-period moving average and the simple 200-period moving average. Please make a note of that. We will not look at a chart, no matter what the time frame, without the 20-period moving average and without the 200-period moving average on the chart. These are the two most dominant moving averages in existence. They are the two most watched moving averages in all the trading world. So, notice that on the right-hand side of the chart, the 20-period moving average is rising. I'm going to give you a formula for knowing when a stock is a buyable stock and when a stock is a sellable or shortable stock. And here's the formula. If the stock is rising above a 20-period moving average, and if the 20-period moving average is rising above the 200-period moving average, it is a buyable stock. I'm going to repeat that. I want to see, before I buy a stock, for the most part, I want to see a stock that is rising above its 20-period moving average. That's criteria one. I want to see a rising 20-period moving average above the 200-period moving average. Rising stock above the 20, rising 20 above the 200. Whenever we have that formula in place, ladies and gentlemen, every single pullback in a stock is buyable. Every single one. I call that formula, I call that picture the picture of power. Do you know why? Because you and I can't produce that picture. We can't make a stock do this. What can? What is going on to make a stock produce a rising 20 above the 200? A lot of what? A lot of institutional buying. Not buying from you and me, but large institutional buying. And let's face it, ladies and gentlemen, the only way to profit is to actually ride the coattails of bigger players. Because once you buy at $20 per se, for instance, someone else has to drive the stock higher for you to make a profit. And certainly it can't be me or you or your friends, it's large institutions. So in essence, we have to find stocks that are experiencing institutional money flow to the upside or institutional outflow to the downside. And the way to do that is with this formula. When the stock is rising above its 20 and the 20-period moving average is rising above its 200, now every single 3, 4, or 5 bar pullback is buyable. Look at the chart. We've got 1, 2, 3 red bars in a row, and we rally. We would sit 1 penny above that high and enter 1 penny above that high. Once we're in, we place a stop 1 penny below that low, and there's our rally. Now, there are ways to buy when the stock is not in the picture of power. That is sort of out of the scope of today's talk, but I am circling additional buys based on other concepts that we teach in our full educational program. But the point I want you understanding now is that the picture of power is a rising stock above the 20, a rising 20 above the 200. Look at the 5-minute chart. This chart is showing a chart where virtually every single bar represents 5 minutes of trading. Notice the same moving averages. The 20-period moving average, simple, and the 200-period moving average. Notice that this stock is demonstrating the picture of power. Rising stock above the 20, rising 20-period moving average above the 200-period moving average. Now get this, guys, when you have the picture of power in place, the 20-period moving average becomes a magical line of support. It is not support all the time, but only when it is experiencing the picture of power. So when we have a rising stock above the 20 and a rising 20 above the 200, the 20-period moving average will act as a trampoline for the stock. The stock pulls back to the 20-period moving average and ricochets off the 20. Pulls back to the 20-period moving average, ricochets off the 20. Pulls back to the 20-period moving average, ricochets off the 20. So guess what? I teach my traders that when you have the picture of power, I want you looking for buys at or near the 20-period moving average. But how do you know the stock is actually going to stop its pullback, its decline at or near the 20? How do you know? You don't know. So I'm not only looking for a pullback back to the 20, I'm not going to guess. Guess what color bar I need to occur at or near the 21st? What color? Green. There you go. So I'm looking for a pullback back to the 20-period moving average and then a formation of a green bar. If I get a formation of a green bar at or near the 20, I strike. That's when I'm looking for my buy. Green bar at or near the 20, strike. Green bar at or near the 20, strike. Green bar at or near the 20, strike. But only during the picture of power. That's the key. The 20-period moving average is not a magical item in any other scenario but this picture of power. And once again, that is rising stock, rising 20 over the 200. Now you apply that approach. Make sense? All right. We looked at this chart. This is the picture of power to the downside. We've got a declining stock below the 20, a declining 20 below the 200. That means institutions are leaving the building. They're dumping the stock. They're waiting for micro rallies to sell, waiting for micro rallies to dump more stock, producing lower lows and lower highs. When you have the picture of weakness, right, this formula, the 20-period moving average becomes a magical line of resistance overhead. Here we have the stock rallies to the 20-period moving average and drops back. Rallies to the 20-period moving average and drops back. Rallies to the 20-period moving average and drops back. So now we teach our traders, within the picture of weakness, you're going to look to sell short at or near the declining 20, but only after the formation of what color bar? Give it to me. Red. That's it. Red. Green bar, green bar, green bar, red bar at or near the declining 20, strike. Green bar, green bar, green bar, topping tail, red bar, strike. Green bar, green bar, green bar, green bar, red bar at or near the 20-period moving average, strike. So the 20-period moving average becomes an incredible, almost magical area of resistance, but only during the picture of power. Without this formula, the 20-period moving average means nothing.